We're here to talk about Silicon Valley real estate market ending the week of January 31st. I'm Richard Calhoun, real estate broker here in Creekside Realty. These are the key chapters in the corresponding graph. You can jump to each chapter in the timeline in the YouTube description. You can jump right to the section you find most interesting. There's a couple interesting things I want to point out this week. One is, and it's hard to see, we'll see it here in a second. Notice how rapidly this curve here is going down. That's actually days on marketplace, which indicates an increasingly hot marketplace. But I think the reverse is actually true, and I'll explain that in a few minutes. And the last one is chapter 15. I've brought in some new data. So if you've been a repeat visitor, you may want to take a look at that. I'm basically including the change from last week and 5 weeks ago. Real interested in knowing if people would prefer last week and a year ago. Here's the first data slide. It's a summary slide. What you're doing here is the thin gray line is your 10-year median. The blue line is the line that out of the last 10 years that would favor the buyer the most, and the red line is the line that would favor the seller the most, the red hot seller's marketplace, and the nice cold buyer's marketplace. The purple is the actual data. First graph we're looking at is inventory. We went from 2,300 almost down to 1,500. So a significant drop within inventory. But that happens at this time of the year. You can see how the purple line and the gray line are very similar. But starting 4 weeks ago, we bottomed out and we had a very limited inventory. But now for the last couple of weeks, we've been gaining. And right now we have absolutely normal inventory. In fact, we're 103%. So we're 3% above normal. That is absolutely normal. There is going to be some fluctuation. In fact, I consider about 12.5% on either side of 100 to be completely normal. Just 13 weeks ago, a quarter ago, we were only at 84%. So we've gone from a shortage of inventory to normal inventory. Looking at offers accepted, they have done something slightly different. They went from 81%. So they also was a shortage of offers being accepted a quarter ago. But that amount of lack of offers is roughly the same. It's 85% from 81%. That's not much of a shift. Yes, the raw numbers have gone from 2,000 on the left-hand side to 1,055. That's cutting your number of offers in half. But that's why it's so important to know what the data normally does in that at this time of the year, which is why we have the gray line. So you can see that in a nutshell, the offers have been limited. They've been on the blue side of normal, and they have not come back with the increased inventory. And the reason that's important is a lot of people and a lot of media are saying that we've been in a supply limited marketplace. This chart, or these two lines, these two segments of this one chart shows you that's not true. If you were an inventory limited marketplace and you've gone from 85% of normal inventory to 103% of normal, your offers would have increased, and they would have increased the same amount as your inventory. So we'd be going from 81% to 100% of normal. That is simply not happening. So we've not been in a supply limited marketplace. And if the buyers don't come back, the offers don't come back, eventually inventory will grow and the market will slow. Now let's look at days unsold inventory. This is the supply demand balance, the seller buyer balance. You were completely normal up until about 4 weeks ago. And then starting 4 weeks ago, you went on the side of the buyers. Now, I will point out that it's been improving. And this is mostly because of the lag time. Right at this time of the year, inventory is growing so rapidly each week, and that inventory hasn't been available to purchase. And that could explain this 85%. I don't think the supply is growing that much, but we'll see a number showing in a little bit that it's gone up like 24%. New listings has gone up 24%, and that would probably explain this 15% lag. Anyway, we'll get in more on that in a second. Now, this is the days on market, which I was showing in the introduction slide, is dropping off. And almost everybody would immediately go, wow, we're going a lot faster. In fact, you're selling twice as fast in half the time, less than half the time that you normally do, and you're below the red line. The reason I'm willing to suggest that this might not be a superheated marketplace is if you have a lot of inventory coming on the marketplace, the market that the buyers are going to be buying are the new inventory. That's going to pull down your days on marketplace. And if there's enough inventory in the new listings to meet the buyer demand, then they're not going over and looking at last week's data, the data that's the listings that have been picked over, and that doesn't pull the DOM back up. So it's actually my thought process right now, and it's subject to change with new data, that the reason the days on market is dropping down so much is not the fact that the market's superheated, as I said, but the fact that the buyer demand that's out there, that 85% versus the 103%, is being satisfied with the new listings, and therefore they're not looking at the listings that have been on the market for a week, and that will cause inventory to grow and the market to slow down. Price cuts, sort of the same thing, although this is pretty much benign. It's right at normal, and that's simply because at this time of the year, with all the sellers just coming on the market after the new year, they don't have time to reduce their price yet. This may change over time, but as of now, it's not. And then overbidding is a lagging indicator. The reason it lags is we have to get the sold price. That takes escrow's closing. At this time of the year, that's probably a 5-week process with the holidays and buyers feeling no pressure to buy. So the negotiations that are reflected in this data is still data that happened, market conditions that happened back in December. Here's looking at the data over long term. So we're going all the way back to 2015. You have 9 years on this condensed scale up through 2023. All of 2024 is on the expanded scale. It's about 2 to 1. That gives you, in other words, this is 1 quarter. Each one of these lines is a quarter. This horizontal distance is double from 2024, and that's just so that we can see current trends. You can see the inventory in the purple line here has gone down at the end of the year, like it always does. You can see how rapidly that has grown up and the steepness of that, and there's no indication that that's about ready to roll over. Now, it does roll over pretty quick. There was an indication last week that we may have rolled over on the DUI, and this week we have. But you can clearly see inventory's gone up from some number around a low of about 73% up to some number now around 103%. So inventory has gone up 30 percentage points. That's pretty significant to do that in 1 month, because this is January the 3rd, this is January 31st. That's 4 weeks. Now, looking at the number of offers, yes, the offers are going up, but they're not going up as rapidly. And I would actually say they're lagging behind by more than a week. If the offers were keeping up with the new inventory, there would only be a 1-week shift. And this looks like a greater week shift. And so now you can see that you've gone from basically 70% up to some number like 86%. So you're gaining offers accepted, but you're not gaining them at the rate of your offers. Now, that's why DUI, the ratio between the two has gone up. Now, this last 2 weeks, it's rolled over. Last week, it rolled over. You can see 2 weeks ago, it was right here at the peak. A week ago, it was here. And now this week, it's down. But it's still that 10% slower than it normally is. Now, I'm going to call that a normal marketplace, but I think it's an indication that the market may be not as hot as people think it is. Here's your inventory. And here you have the 3 lines, your normal line right here, 10-year median, 10% median, least inventory you'd expect, and the most inventory you'd expect on the blue. And again, you're just seeing it. You went from the least inventory you'd expect at under 1,000 listings for all of Silicon Valley, Santa Clara, San Mateo, and Alameda counties, up here to normal inventory at 1,500. So we've gained 50% of our market in just the last 4 weeks, the 3rd through the 31st. Here's comparing that gray line is now stretched out. So instead of showing you the half sine wave that repeats every year, he drew that out and say, what percent of normal is it? And inventory was basically down here at 73% of normal. It's now up here at 110% of normal. Here's the offers accepted. It is not doing the same thing. It is staying right on that blue line. Now, it's hard to see on this because the blue line and the gray line are so close together and it's a vertical separation. But just looking at this, you're basically not getting any offers. You're having a gain in the number of offers. The offers went from 750, or I guess that'd be 600, up to 1150 here. So the number of offers accepted has doubled, but that's not keeping up with the rate of growth that it normally goes up at this time of the year. Here you can see that it's come up some. You've gone from that 70% up to some number like 86%. So you're getting close to that realm, 12.5% on each side of 100 that I consider normal, but we're not quite there yet. Here's days of unsold inventory. Now, this is the supply demand balance. This is more important than either one of the indicators, and it's the vertical separation. So you can see that normally DUI is falling at this time of the year. So the fact that it's falling here was to be fully expected, but now it's the vertical separation here that's important, not the horizontal, because horizontally we're almost touching. Vertically, we're still fairly far apart. And here you can see we're 10% apart. We were a little bit further apart last week and the week before. Last week's right here, and the week before that is up here. Now you're down here, but you're still 10% slower than you normally have been. That's not dramatic when you've been basically at normal, but it's just, we're not in a superheated marketplace for Silicon Valley. Anywhere else in the country, we're probably considered superheated. Here's the days on the marketplace. Now, this is actually interesting because a couple things are noteworthy here. Is note the shift from the gray line back to the purple line. That's interesting in itself. And then it's dropping down like it normally does. But as I was saying in the earlier part of the presentation, the reason I think it's dropping down is not that everything's getting gobbled up, but what's getting gobbled up, the demand, the offers that are getting accepted, is getting completely satisfied by the new listings, and buyers are not now resorting to properties that were on the market for 1 or 2 or 3 weeks that may be able to negotiate the price down. Even though this would indicate a superheated marketplace, and it's more of a horizontal shift for some reason. I have no idea why that horizontal shift has occurred. This is clearly the first of the year. We clearly have 4 data points after the first of the year, so there's not a problem with my X plotting, which is what it looks like to me just looking at this. Also, it's not that because, just last year, your peak was right where you'd expect it to be. So we've had a shift. And again, I think that's because buyers are getting their demand satisfied by the new listings. Here is compared to normal. So now you take that gray line, and I mean, look at that drop. We're at some of the lowest levels that we've ever been, but I'm almost being a little pessimistic than super optimistic. If you looked at this data just on the face of it without any other information, you would say the market's absolutely on fire because 3/4 of the sellers are selling their home in less than half, in about 40% of the time that they normally did. And the only time that it was really faster than this was early in 2022, right before the market did its collapse starting on Valentine's Day of 2022. Here's the sellers that are taking the largest price reductions. You can see we've gone from more than normal number of price reductions to less than normal price reductions. And that's not that the sellers aren't taking price reductions, in my opinion. It's because the offers that are being accepted are the new listings on the market. The buyers aren't going back and looking at those price reductions. Even if the seller takes those price reductions, if the offer doesn't get accepted, it's not reflected in this data. Here's the same concept. So you went from cooler, more price reductions than normal to less price reductions than normal. And you've done that all since the first of the year. Here is showing the average. I prefer the 10%. The reason I prefer the 10% is 85% of your sellers are doing no price reductions at all. And you can see right now, you're talking about 0.4% of a price reduction. That's less than half of 1% of a price reduction, which is nothing. But the reason the average is so small is because the vast majority are doing no price reduction. And you can see that is less price reductions than we normally do for this time of the year, which would be the gray line, which would be down here somewhere around 6/10. So we're taking about 2/3 of the price reductions that we normally do according to this metric. Here is pulling out the gray line. You can see that we're almost where you'd expect it to be, up from a cooler marketplace. So the more price reductions back here last year, all of last year, and now we're basically approaching normal, and we may go to less than normal as early as next week. Here's the frequency of price reductions. So how common are price reductions? It's less than 10%. So in Silicon Valley, in 3 whole counties, less than 1 out of every 10 sellers has reduced their price of the sellers that are getting their offers accepted. You can see it's below the gray line. It's on the red side of the gray line. So it's that clearly favors the seller. Here's the same information with the gray line pulled out straight. So you can see you're down here somewhere around 73%. So you're only seeing 73% of the price reductions that you normally do on a frequency. This isn't the magnitude. This is how common is it? How often, how likely is it you're going to run into a seller that has done a price reduction? Here's overbidding, and this is that lagging indicator that I talked about. So this is reflecting market conditions 5 weeks ago. You can see that buyers are still overbidding their typical overbid, which would be the gray line. So more overbidding than going on, nowhere near the peak levels that we were. And again, it's rare to go below 100%. You can see we went below 100% end of 2022, early part of 2023. The reason for that is there's always going to be some overbidding, and buyers tend to not go in and offer the seller less than they're asking or significantly less than they're asking. They tend to wait for the sellers to reduce their price, and that's why you rarely see this line go below 100%. It does happen. There's nothing preventing it from happening, just the market dynamics. This is just an absolute magnitude. So if you're having the normal amount of overbidding, you'd be at the zero line. Here you're at about 1 1/3%. So the overbidding right now is about 1% more than it typically is. And this is typical, which is the median. And that's why the number's so small. I flip-flop between average overbid and median overbid. This is one of those metrics that I think both numbers are significant. It depends on what you're trying to do. So this is saying that half the sellers are getting more than 1% more than normally do. And they're normally getting about 2% over their ask price right now. So the typical seller right now is getting about 3% over their ask price. And the average was something like 5%. Here's the frequency of that overbidding. So overbidding is more common than it normally is. And note that this is just about the time of the year where you'd expect this to come down and turn around. And notice that there's no indication. I mean, look at the gray line. It's coming straight down and then boom, it goes up. So there's a very good chance that next week this number is going to turn around and start climbing, which would indicate buyers are sensing pressure this year. I'm actually going to throw out that I think it may go up less significantly than it normally does. I fully expect it to go up, but I'm saying that the vertical separation from the valley may become smaller than the vertical separation of next week's data. Here's typical. So right now your overbidding is about 8% more overbidding than it typically is, and this is the frequency. So how common is the overbidding? This is the long-term price appreciation. And here we go all the way back to 2014. So we're going further back in time, and we're not changing the x-axis. And that allows you to draw a straight line, which is the appreciation. So right now, we're below where you'd expect it to be. We'd expect this to roll up. And I'm not so sure it's going to roll up this year. There's a couple things that happen. One, your peak of the time didn't last as long. You got back to the sloped line earlier than you did. You had your V, and now you're sort of having a trough. Typically, you don't. That trough is pretty narrow. Unless prices start going up pretty rapidly, I'm not so sure we're going to see that this year. I guess what I'm saying is I fully expect to see price appreciation. I just don't expect it to be as sharp as it normally is. Here's payments. I'm assuming an 80% loan at the Freddie Mac rate. So at the high balance conforming rate, which obviously you can't even get at the 90% home up here with the most expensive home. It's also misleading in the fact that many lenders won't loan 80% on the most expensive homes, but it gives you some idea of relativeness. I need an easy to find metric, and the high balance conforming loan was easier to find than jumbo money. Here's your typical payment down here for what the typical buyer is doing, just shy of $12,000 a month. That includes an estimate for property tax and insurance. Now we're moving on to distributions. We're doing 3 distributions. This is days on market. Look at how steep the line is getting over here. So what this is saying is the sellers that have been on the market the longest is increasing fairly rapidly. Now notice that in the past it does it too, but I would actually say that this line is steeper than it normally is. So a greater percentage of the buyers, somewhere approaching 75% of the buyers, are being satisfied. And the real number is probably closer to right about here. So about 72.5% of the buyers are being satisfied in properties that have been on the market for just about 2 weeks, which is at the end of the time frame of sellers will entertain offers. A lot of sellers, and probably the bulk of the sellers, will do it after 1 weekend. Some sellers want 2 weekends. What this distribution does is we start off on the dotted line here that's bold, which was a year ago data. You can see that the shape of the line, the purple line, is steeper. In other words, the dotted line's up here and the purple's down here, and they meet up here. So it's sagging down to the right a little bit more on the purple line. But what you do is you initially move 1 week at a time. So we're on this January 31st of 2024, then February 7th, the 14th, 21st, and then the 1st. And this is because of my calendar year. I use a real estate calendar year of March 1st. And typically, if you just looked at this, you'd expect the 28th, but we want to get back to March 1st for comparison. And then after we hit March 8th, we jump 2 weeks at a time. After a quarter, 91 days, we go from dotted lines to dashed lines. We have 183 days with dashed lines, and the most recent quarter is the solid lines. And again, after a couple weeks, we come to weekly data. So that starts right here on the 27th of December. So if we have a month of data on weekly data. So let's step through and watch the actual data. Here you can see you've dropped down. So you'd expect the purple line to drop down. You'd expect the trend to be the same. There's about the bottom of the marketplace. Now you're starting to slow down. That was a quarter ago. And now you're still rising. And now you're sort of at the summer plateau where the data just fluctuates from week to week with no real change. Now you're in the last quarter of data and you can see it really slows down. There's sort of the slowest week of the year, and now you're accelerating. So what's that tell you? It tells me that I would expect this line to continue to go down, the purple line, the current data line, to go down for at least about 3 or 4 more weeks before we see anything. The question becomes, how steep does it become and how much does it go down? Same concept with price reductions. We'll just get it going pretty quickly, but you can see that the purple line is quite a bit higher towards the red line than the dotted line from a year ago. So there's a lot less price reductions going on this year than there was last year. And you can see that the dotted lines are going up to the left, getting hotter and hotter. And there's the peak of the marketplace. Now you're cooling off. So that's telling you you'd expect that purple line to go up and then cool off. And you've got the same summer bounce. And then you get into Thanksgiving time frame and boom, big drops down. And then you get into New Year's and the number goes up. So again, what's that expect the market? Well, I expect the market to continue to go up in this direction. I expect it to exceed last year's number of being on the higher side. So lower price reductions. Up here on the red dotted line, which was our best week ever, which was February 14th of 2022, was basically no sellers. Well, 97.5% of the sellers were doing no price reductions whatsoever. Here's the same thing with overbidding. Overbidding is interesting because it lags behind. And the purple line is the current data. The dotted line is the data from a year ago. And I think what we're going to do is see that from a year ago, the data goes straight up. Yep, it jumped right up on the first week and keeps just climbing. So this would indicate the purple line is just about, and there's the peak right there. Then you cool off. And overbidding is a little bit more consistent, a little less volatile than some of the other data that we've already looked at. Buyers just sort of average things out. Escrows close in different lengths of time, so it becomes a sort of a mismatch of data. It's a little more blended. Now we're getting right up to current day almost. That was last week, and this is current week. You can see that the overbidding is a little bit more aggressive because the purple line is above the dotted line, the year ago line, and the year ago line was the bottom of the marketplace. So I'd actually expect this line, the purple line, to stop decreasing and turn around and go up. Now, anything can and does happen, but I would expect an increase. I'm just not expecting as much of an increase as we might otherwise expect. Here's now looking at the components broken out by county. We have San Mateo County in the orange, Alameda County in the gray, and Santa Clara County in the blue. You can see that historically, Alameda and Santa Clara County have roughly the same level of inventory. Here you can see that Alameda County has significantly more inventory than Santa Clara, not quite double, but something like 460 listings in Santa Clara County to something like 730 in Alameda County. San Mateo County is a much smaller number. It's just a smaller county. Here's offer accepted. Now here, your Alameda County and Santa Clara County are right on top of one another. Santa Clara County had less inventory, so the marketplace in Santa Clara County, as we'll see in the next slide, is going to be much faster pace, more rapid turnover than in Alameda County, because you have the same offers, you have the same demand, but in Alameda County, you had what, 60% more inventory. You can't compare San Mateo County right off the bat because their inventory is not normally the same. And look how consistent the offers are here. So even though the inventory changes, the level of offers accepted is pretty similar between Alameda and Santa Clara County. So the offers accepted, for whatever reason, matches better than the inventory matches. So here's your days unsold inventory, the demand, supply demand balance. You can see Santa Clara County in the blue is the fastest marketplace, turning over the existing inventory in 38 days. San Mateo County is actually in second place at 52 days, and Alameda County, with its larger inventory, is the slowest county at 58 days. Now, you got to keep in mind, 58 days is less than 2 months. The bulk of the nation considers them to be in a balanced marketplace, and it depends on who you talk to, but somewhere between about 3 and 7 months of inventory. We're talking about it being the slowest at just under 2 months. That's noteworthy. For whatever reason, our supply of inventory is very limited in the Bay Area. It probably has something to do with the fact that we have oceans and bays and mountains around us, and that we've been established for a long time, that we're the tech center of the world. We're almost an educational center with Stanford and UC Berkeley and Santa Cruz and San Jose State. So the University of Santa Clara, there's a lot of opportunity here, and we just don't have the inventory of housing that we need to meet the demand. That turns over the inventory that we do get very rapidly, and that's what this graph is showing. Here's marketing time. You can see they're all plummeting down. Noteworthy here is, even though San Mateo County had a longer DUI than Santa Clara County by a fair amount, their marketing time to sell 3/4 of the listings is the same. And that goes along with my thought process for the last 4 weeks, 5 weeks. So this is 5 weeks data. The buyers are being satisfied based on the listings that just hit the marketplace, and nobody's reaching back and taking that old stuff, the listings that have been on the market for a month. Anyway, so 3/4 of your sellers in both San Mateo and Santa Clara County are selling in basically 2 weeks. In Alameda County, it's about 31 and a half days, just over a month to sell 3/4 of your inventory. Here's your price reductions. Santa Clara County is the least. I don't know if you can see it, but it's right about there is the purple line, the orange line. If you look on the right side of the blue line, you can see it hanging out just about there in elevation. It's about 95%. Santa Clara County is about 97.5%, and Alameda County is at 92 3/4. That means the sellers are getting 99 3/4 of their asking price. They're only taking 0.3% price reductions. This is average. This is what I call a very tight metric. You know, some of the biggest numbers you saw here is where the sellers were taking a 3% price reductions. You can see the vast majority are taking less than 1% over time, and that's why I call it a tight metric. Here's the frequency of those price reductions. Again, Santa Clara and San Mateo County are on top of one another. Here, it's really hard for me to see. I would actually say that San Mateo County is having a little less frequent overbidding than Santa Clara County. You can clearly see them right here, and they're going both down at the same rate. They're probably identical. You know, call them both tied at 7%. So that means only 7% of the sellers that have sold their property in the last 5 weeks took a price reduction. In Alameda County, it's a little bit higher. You're up here somewhere around 12.5% of the sellers taking price reductions. Here's the overbidding. San Mateo County is the least overbidding at basically 3%. Alameda County is next at about 3 3/4%. And Santa Clara County has the most overbidding at 4.5% of overbid. Here's the frequency of overbidding. Least frequent overbidding, sort of interesting, in San Mateo County. So less than half the sellers are getting more than their asking price. Santa Clara County is the most at 58% of the sellers are getting more than their asking price. So in rough terms, 50%, 55% of the market is getting more than their asking price. Here's the long-term appreciation. Santa Clara County's got the most appreciation, about 87.5%. This is since the last 9 months of 2015. San Mateo County is in second place here at 55% appreciation, And Alameda County is now in last place, a flip from last week here at 50% appreciation. So you've gotten 50% of your money, and considering that most buyers buy a property, especially if we're talking about the typical buyer with a 20% down payment or something of that order, that multiplies your 50% leverage by 5. You've got a 2.5 time return on your cash investment. Now, of course, you make the mortgage payment, which is usually higher than rent, but you have pride of ownership and those kinds of things, and you don't have to worry about the landlord kicking you out. Here is the sold price. Notice how close we're getting back together, but San Mateo County is still just under Santa Clara County. A little hard to see on here, but they're very close together. No longer the big difference that we had of $100,000. I would wager this is probably somewhere in the ballpark of a $10,000 discrepancy, but Santa Clara County is on top. And then Alameda County is down here at about 1.1 million. And the other two are about 1.8 million. Here's the same information on regular paper for those that prefer. The separation is a little broader here. You can see that Santa Clara County is at 1.8 and San Mateo County looks like it's about 1,790. So about $10,000 separation. And Alameda County is just over 1.1. Looks like about 1.125. Here's the estimated payments using the national average. You can get better than that by going with jumbo money. Jumbo money now is cheaper and has been for probably a decade now. Conforming money used to be less expensive, and it swapped and it hasn't reverted back. Here now are my heat maps. Here's your active inventory. Just looking at this, you would say that you got some areas where you have a little bit more inventory in the blue favoring the buyers, a little bit less overall. You're right at normal, it looks like. Very little color. And in fact, Silicon Valley, you can't get closer to 100% than that, 100.2%. So exactly normal inventory. Santa Clara County is a little bit low at 83%. San Mateo is a little high at 15% more inventory than expect. And Alameda County is pretty darn close to normal at 7%. You have areas like Santa Clara that have less inventory, followed by Alameda County, and San Mateo County has the most. Here's offers accepted. You can see we're sort of blue in color. Redwood City is the only red area, and it's doing actually 44% more inventory. And for these first three maps, I only have county-wide data for Alameda County. But Silicon Valley wide, you can see, is at 85%. Santa Clara is at 86%. San Mateo is at 88%. And Alameda County is at 85%. So you can see that your offers accepted are down in that 85% range, and your inventory was up at about 100%. So you can see that offers is lagging behind inventory. Days unsold inventory right off the top, I would say it's either blue in color or white in color, mostly white, but a lot of areas here have blue. So those areas are going to be slower than they normally are for this time of the year. The only area hotter is Redwood City at 65%. So your speed of the marketplace is 2/3 what it normally is. It's faster. This is one of those metrics, the lower the number, the faster the marketplace is. But again, you can see overall, if anything, you're lagging behind. So this is again indicating there's more inventory than there is offers. Here's your days unsold inventory. So now if you just don't compare to normal, just look at what the raw number is, you can see you're hot. So even though you're slower than you normally are, you're still a fast-paced marketplace. You got a couple major exceptions in San Mateo County, 161 days for the San Mateo County coast, like Half Moon Bay, 107 days to sell your inventory in the expensive areas in San Mateo County. And noteworthy up there is Hayward, 103 days, and then Oakland at 87 days. So there are some cool areas, but a vast majority of the geographical areas are red in color, which is a fast-paced marketplace. Here's your marketing time. So this is that 75% of the sellers are selling, basically red hot. So sellers that are selling in fast times. You got a couple major exceptions, Saratoga, Los Gatos, the expensive areas in San Mateo, and even San Mateo County coast, 42 days. So that's the beginning of the balanced marketplace. Ask price readjustments, very low where you have red color. So overall, sellers are not doing price adjustments at this time of the year, which is what we've talked about and what we'd expect. Frequency, very infrequent. Very few sellers are doing price reductions. You can go find them. They're out there, but less than 10% of the sellers overall are taking a price reductions. Less than 7% or 7% in Santa Clara and San Mateo County, and in Alameda County, it's at 13%. Here's the magnitude of overbidding. So you can see where our buyers are feeling the more pressure to overbid. And in the coast over here, they're going under. They're going under 6%. That's pretty amazing number. It's rare that it's that high. It's usually within 2% of the seller's ask price, and it's usually above. Here's the frequency of overbidding. Right now in Half Moon Bay, 0% of the sellers got more than their asking price. You can't get bluer than that. But in most of your areas, you're seeing a significant amount of overbidding, which is why it's red in color. This is the long-term appreciation. So the areas that are red saw the most appreciation, sort of the moderate priced areas that have reasonable commute to the job centers. The areas that had the least appreciation are the areas that used to have a huge premium for commuting. And Livermore is basically back to normal. Here is your pricing. So these are the blue areas are the more affordable areas, the least expensive. The red areas are more expensive. So San Mateo County and the west area of the Santa Clara County are still clearly the more expensive areas. And in addition to following the median price, which is the middle number, I put in the least amount price you'd expect and the most. So you have a range, a sandwich of where you're to expect price range. Here's a summary of that information. You got the geographical areas on the left, the monthly payments, and the price range on the right. You can go through and see what kind of market conditions you'd expect in the different geographical areas. In general, they're going to be fairly consistent. The highlighted ones are sort of your leading indicators. These are somewhat indicator, but you got to be careful on how you interpret it. And the orange are lagging indicators because you need that sale price. Here's your raw numbers for each one of the counties in Silicon Valley overall. Here's where I was talking about. You're seeing a 27% growth in the number of new listings over the last 5 weeks compared to last week. So last week to this week, over the past 5 weeks, you have 25% new listings. That's new on the market. These numbers here at 7.5% are your total inventory. This is your offers. Your offers have gone up 25%. And then you have your DUI is going down at this time of the year, and that you'd expect that. And then you have the rest of the metrics, and you have appreciation since 2015 here, and since 2020, basically since the pandemic down here. This is up here for the lack of offers accepted. You can see that 808 is getting very close to 802. I'd almost expect it to change next week. 866 is very close to 847. And 1061 is significantly at this time above 991. So these two are in serious jeopardy of becoming the slowest 10 years. We will likely have 4 weeks in a row where this is the worst out of the last 10 and the last 25 years. Lack of offers accepted is still an issue. We've been talking about the Silicon Valley real estate. We will be talking about the Greater Bay Area in 13 counties and 5 regions. The blue YouTube gets you to the archive on YouTube. You can go pick whatever video you like. I would appreciate likes and subscriptions. It does help get the channel out to new viewers. To join the presentation Saturday morning live, the green root URL plus the year 2025. If you want the handout, you type in the green root URL H for handout 2025, the month and date, which would be 0201. And then any specific episode. I'm Richard Calhoun, real estate broker with Creekside Realty, working with buyers or sellers here in Silicon Valley. Let me see if there's any unmuted mics. Not seeing any unmuted mics. We'll move on to the Greater Bay Area, 13 counties, 5 regions. These are the 5 regions. We've been talking about Silicon Valley already. We add in San Francisco and Marin, the North Bay, the Central Valley, and the Central Coast. We cover the 10 years going back to 2015 through 2024 as our 10-year period. We compare the current year, 2025, to that 10-year period. Here is the active inventory. You can see that we start back on January 1st, 2015. We have the condensed scale through December 31st of 2023. In 2024, we have the expanded horizontal scale. It's about 2 to 1. So you can see trends. And the trend that you're seeing here is inventory bottomed out on January the 3rd across all 5 regions and has been increasing. Probably the biggest rate of increase here is here in Silicon Valley. It isn't the largest inventory, but it's gone up by more. It's gone up basically 3 whole segment boxes. And if you come up here to The North Bay, it's a higher number, and it's only gone up about 2.25 boxes. So Silicon Valley's had the greatest increase in inventory. Here is the number of offers accepted. Again, you can see the bottom is later than January the 3rd. It's probably about 3 weeks ago. So there's a lag behind there with the number of offers going up. The number of offers going up is more consistent across the regions that are roughly the same size. In other words, the increase in Silicon Valley isn't greater than the increase in North Bay or the increase in the Central Valley. Obviously, down here in the cities and the Central Coast, the increase in raw terms is smaller, but that's because the magnitude of those areas is smaller. You can see these three regions up here are roughly the same size, and then these two regions are roughly smaller, but the same size. Here's your days on sold inventory. So this is the speed, the supply-demand balance. Silicon Valley is the fastest mark. Again, they're all improving in the last 2 weeks. And the slowest is the Central Coast at 100 days to sell out your existing inventory. For Silicon Valley, that's, a little over 3 months. And that seems slow to us. But for most of the nation, that would be on the fast side of their normal marketplace. I think most places consider 3 to 7 months to be a normal turnover rate. Here in Silicon Valley, we're about 45 days. So it's about 47 days. So you're a little bit more than a month and a half. Then you have 3 that are close together, but they're fairly close together. They're all somewhere between 60 and call it 72. So each side is say 65 or 64. Here's the marketing time. This is a sort of an interesting metric. It's how long does it take 3 out of 4 sellers to sell their property? You can see in Silicon Valley, it's dropped down fairly significantly. It's almost to the lowest level that it has been. There have been lower levels, but this will continue to come down. You notice that it's the one area that's not coming down is the Central Coast, where it's actually gone up a little bit. Not only has it gone up from last week, but it's gone up from a couple weeks ago. There was a little bit of a V, but their trend is still up. The other 4 regions, including Silicon Valley, has rolled over and gone down, which indicates that 75% or 3 out of 4 sellers of this are selling in less time than they were before. Here's this price reductions. Notice the number of price reductions that are all going up, which is a reduced price reduction. Up here is 100%, which would be 0. Somewhere around half of 1% is what I consider to be a normal marketplace, with some sellers doing price increases and some doing price reductions. You can see that there are small periods back in 2021 and 2022 where the market actually was over 100%, so sellers were actually raising their price. There was also a period of time here for Silicon Valley way back in 2018 where that happened as well. So it's not unheard of for prices to increase. This is the frequency of price reductions. This is how common is it. You can see that it's going down in all the regions. Central Coast is probably more flat than down, but from last week to this week it's definitely down. But the trend globally for Central Coast is more flat, but the other 4 are all down significantly. The area that's down probably the most would be cities, San Francisco and Marin, dropping from somewhere around 35% of the sellers doing a price reduction to now something around 16% of the sellers doing a price reduction. So more than cut in half. Silicon Valley's improved by 50% as well, going from 20% to 10%. Lower magnitude, but still 50% fewer sellers are reducing their price. This is the magnitude of overbidding. This is a lagging indicator, so we're still not to the bottom yet. You have a couple areas, Silicon Valley and San Francisco Marin, where it looks like it's flat. I would expect this to start increasing next week, but other 3 may not bottom out until next week and increase the week after that. Here's the frequency of overbidding. So how common is overbidding? Least common in the Central Coast area, with only 25% of the sellers getting more than their asking price. Most common here in Silicon Valley, with something like 55% of the sellers get just over half. San Francisco and Marin is about 45%, just under half. Then you drop down to North Bay at something like 37%. And then Central Valley is under a third at 32%. And the area that has the least amount of overbidding is the Central Coast at 1 out of 4, or 25% of the sellers getting an overbid. Here's the long-term appreciation. The big takeaway, as it has been, is the lack of appreciation in San Francisco and Marin. You can see that before the pandemic, all the areas were getting roughly the same rate of appreciation. Once the pandemic hit, San Francisco and Marin really lagged behind. Did okay in 2021 and early 22, but basically since July 1st of 2022, it's been down and been really low for a while. And if you go back in time, you're getting back to prices that first hit this level in 2018. So they're approaching something like 7 years with essentially zero appreciation in the cities. The area that's had the absolute most appreciation is the Central Valley at 82.5% probably, followed by the Silicon Valley at around 75% appreciation, and then a two-way tie for the North Bay and the Central Coast at about 58 and 59% appreciation since 2015. Here's the median sold price for the different regions, Silicon Valley being the most expensive. It's more expensive now than San Francisco and Marin, so Silicon Valley is the most expensive region in Northern California. Central Coast is in the middle at $1 million. North Bay is reasonably priced at $750,000, and the most affordable was the Central Valley at about $525,000 for your median priced home. Here are the payments going through, assuming an 80% loan, throwing in an estimate for property tax and insurance, and using the 30-year fixed high balance conforming loan based on the federal national average. This table has been updated a little bit for you. Instead of just having the current level of offers, I have the percent increase from a week ago and then also from 5 weeks ago. So your inventory right now in Santa Clara County is 468. That's up 9% from last week and up 33% from 5 weeks ago. Inventory offers, I decided to do that on a percentage basis because the level varies so much, and that way you can look at the percentage. And, like on offers accepted, you can see it's up in San Mateo County by 5%, but then you can come down to Marin and it's actually down by 33%. So you can see there's quite a bit of range. Inventory overall is up in all the areas, not only on the 5-week basis, but also on the 1-week basis, although Solano County at 0.3% is pretty flat. And then when you start getting into the rest of the metrics like days unsold inventory, it's already normalized. So here, this is simply raw count. So your current value for Santa Clara County is 37.7 days. That's down, which is an improving market from a week ago. It's up 13, which is a slowing of the marketplace from 5 weeks ago. So 5 weeks ago, the market was faster than it was now because we didn't have the low volume of sales. That's how you read the table. I thought that it might be more interesting to have some more data. The real question I have is, do people want 1 week and 1 year ago, or do you like the 1 week and 5 weeks back? If you have a preference, let me know. And there's not very many viewers that make it to this point in the video, so 1 or 2 people could control which way they go on that. Sale price to list price ratio, again, this is already normalized and this is in a fluctuate. And you can see basically most of the numbers are negative. You can see there are some positive numbers on here. Frequency of overbidding, then appreciation. I didn't think this number really changed that much, and I was running out of horizontal space. Also on price, I only did the last week versus this week for the median. I didn't do it for the 10 and 90%, again, because of horizontal space. So appreciate feedback, whether you want 5 weeks or 1 week, and any other comments you have on this, how I can make this information more presentable. With that, I'm not seeing any questions. I'm not seeing any unmuted mics. So as I close out, these are the different chapters. You can jump to the section that you find most interesting and watch that portion. I really appreciate some likes and subscriptions.